Anthropic. Wow. The AI company just leaped from, was it $61.5 billion to a reported $170 billion valuation.
Yeah, in just 4 months. It's kind of mind-boggling.
$108 billion added.
Yeah.
Faster than Amazon grew in its first decade.
Exactly. And while everyone's, mesmerized by that AI speed, there's something almost as seismic happening, maybe more quietly, on the crypto policy front.
Right, this impending White House crypto report.
Precisely. And the whispers about a potential U.S. strategic Bitcoin reserve. Putting those two things side by side, AI and this potential policy shift, it really feels like a major inflection point we're living through.
Okay, so welcome everyone to the deep dive. Our goal today, to really cut through the hype and give you the crucial insights on these huge shifts in AI and digital currencies. By the end of this, you should have a much clearer picture of not just what's going on, but more importantly, what moves you might need to start thinking about right now.
Absolutely.
So here's the plan. First, we'll dig into that Anthropic valuation, why it's maybe more than just a bubble.
Yeah.
Then, we tackle the big crypto policy changes that seem about to break.
The SBR and stablecoins, yeah.
Exactly. After that, we'll look at the IPO market, 196 IPOs in 7 months. What does that signal for your portfolio or your business?
A lot, potentially.
And stick around, because we've got a bit of a surprise twist, a contrarian view on maybe the most overhyped tech we might see in 2025.
Yeah, I think that'll be interesting. Look, the numbers flying around Silicon Valley, the ones kind of breaking people's brains, they're just the start. We want to show you how it all connects, how it's part of a bigger story that affects your strategy.
Okay, let's start with that AI valuation. Anthropic, $61.5 billion to $170 billion. I mean, the velocity is just... It makes the dot-com boom look almost quaint, doesn't it?
It really does. But, while the numbers seem almost unbelievable, maybe unsustainable, it's not just irrational exuberance driving this. I think what we're seeing is a massive land grab.
A land grab for what, exactly?
For the future of productivity, essentially. McKinsey thinks AI could unlock something like $15 trillion in economic value by 2030. So think back to the 1800s, the railroads.
Okay.
That's the companies laying the actual tracks. They captured huge returns because they controlled the essential infrastructure. Today's big AI models, the frontier models, they're the new rails.
That's a good analogy.
And the cost to train these things, it's hitting $100 million easily and climbing. So you naturally get an oligopoly forming. The barrier to entry is just immense. It concentrates the power and the potential returns in just a few hands.
So if these models are the new rails, the new infrastructure, what does that mean for listeners right now, if you're running a business?
Well, for business leaders, I'd say you probably have maybe 6 months. Before the costs of switching between these big AI vendors become really prohibitive, you get locked in.
6 months, that's soon.
It is. The smart companies, they're already looking at 12-month contracts, locking things in now before prices inevitably adjust upwards. And if you're a tech professional, you absolutely need to be mastering multi-model orchestration, like yesterday.
Meaning being able to use different AI models, switch between them.
Exactly. Don't just bet on one horse. Because with these valuations, vendor lock-in isn't just a risk. Your whole tech stack could end up feeling like a hostage situation.
That raises the inevitable comparison, though. Cisco, back in 2000, trading at 200 times earnings, then crash, 90% down. Isn't this just history repeating?
It's a fair question, but there's a key difference, I think. Many of those dot-com companies, they were selling a dream, a future promise.
Right. Lots of eyeballs, not much profit.
Precisely. These leading AI firms today, like Anthropic, OpenAI, Google, they have immediate substantial revenue from Fortune 500 clients, paying real money right now.
Okay.
So the question isn't really if there's a bubble. It's more about which companies have the real underlying value, the strategic position to survive and, frankly, thrive when things inevitably cool off or recalibrate. Which ones have the moat?
That's a critical distinction. Okay, so while AI valuations grab the headlines, let's pivot. Because you mentioned something quieter, but maybe just as significant, happening with digital currencies. Bitcoin crossing $119,000.
Yeah, almost effortlessly yesterday. And look, it's not just retail hype or speculation driving that. There's a deeper current here, and it boils down to 3 letters. SBR.
SBR, Strategic Bitcoin Reserve.
Exactly. That White House crypto policy report, due out basically today, strong indications are it could include a framework for the U.S. government to actually hold Bitcoin as a reserve asset.
Wow. I mean, that would be a massive policy pivot, wouldn't it?
Huge. Think about it. The government, which was pretty skeptical not long ago, potentially becoming a major institutional holder, that legitimizes the asset class on a whole new level. It's
It's
monumental if it happens.
But you said there's something under that headline, too.
Yeah, and this might be even more impactful day to day. While the government is maybe looking at Bitcoin, the big banks, JP Morgan, BofA, Citi, they're reportedly working together urgently on building a unified digital dollar. And it's not because they suddenly love blockchain. It's driven by concern. Fear, maybe?
Concern about what?
Stablecoins. Look at Tether. They're processing something like $2 trillion in transactions annually. $2 trillion.
Okay, that's a huge number.
It rivals the entire volume of SWIFT, the global banking wire system.
Yeah.
So you've got this massive amount of value moving completely outside the traditional banking rails. The banks see that, and they realize they have to act. They need their own digital dollar solution fast.
Right, they need to get in the game.
They have to. So what does all this mean for you listening? If you run a business, especially one dealing internationally,
Yeah.
you need to be testing stablecoin invoicing, right now, this week. Seriously.
Why the urgency?
Because you could save 2, maybe 3% on every single international transaction. That's pure margin dropping straight to your bottom line. It's significant savings just sitting there.
Okay, that's a tangible benefit.
Absolutely. And for anyone in a strategic leadership role, don't just note this down. Form a stablecoin task force. Again, this week, not next quarter. There's legislation coming, the Genius Act.
Right, aimed at modernizing digital payments.
Exactly. It's going to reshape the payment infrastructure. And the companies that move early, that figure this out now, they're going to capture some serious arbitrage opportunities. There's an advantage to being first here.
Okay, so major shifts in AI infra, potential government moves in Bitcoin, banks scrambling on digital dollars. Let's switch tracks again to capital markets.
IPOs.
Yeah, another area that's quietly heated up.
196 IPOs so far this year. That's up 80% from last year. That feels significant.
It is significant. It tells you investor appetite has really shifted. Look at Figma, the design tool so many of us use. They just raised their IPO target to, what, $19 billion? And it's trading at around 15 times revenue. Think back to 2022, a multiple like that. It would have been laughed out of the room.
True. Very different climate then.
Very different. Now, investors are lining up, eager. So what's the broader implication? The IPO window isn't just open.
It's like it's been blown off its hinges. And when private companies see these kinds of valuations hitting the public markets, guess what they do?
They rush to get out there too.
Absolutely. They're scrambling to go public. Just today, July 30th, we saw multiple billion-dollar offerings hit. At SDL in India, Sri Lotus developers, a whole bunch you probably haven't even heard of.
Okay.
But each one of those IPOs, it sucks up capital that maybe a year or two ago might have gone into funding earlier stage startups. Now it's flowing into these bigger later stage deals. It signals a maturing, maybe a consolidation in the market.
So practical advice then. If you're holding equity in a private company, a startup, whatever.
This is your moment. Seriously. These IPO windows, they don't stay open forever. History shows they can slam shut. Fast. Without warning. If you have an opportunity, you need to assess it now.
And what about for small or medium-sized businesses? Does this IPO surge affect them?
Oh, absolutely. This raises a really important strategic point. Your competitors, some of them are about to be flush with cash from their own IPOs.
Right, war chests.
Exactly. So you need to be watching closely who's going public in your sector. Because once they have that IPO money, expect them to get aggressive. They'll acquire smaller players, they'll expand rapidly, they might even slash prices to grab market share.
So competitive intelligence is key right now.
Crucial. Know who's getting funded and what they might do with it. Forewarned is forearmed, already.
Definitely. Okay, let's do a quick roundup of some other key market moves just from today. Keep it rapid fire.
Okay, first, Player Zero. They just landed $15 million Series A. Their tech is AI that finds bugs in code automatically. Think of it like an immune system for your software.
Interesting. Actionable takeaway?
For strategic leaders,
Yeah.
budget maybe 15% of your dev resources for AI code review tools by Q4. It's becoming essential QA.
Got it. Next.
Ramp, the expense management company, just raised $500 million at a $22.5 billion valuation.
Wow. Expense management really is printing money.
Apparently so. Quick tip. If you use Ramp, maybe look at locking in your current pricing plan now. Post-IPO price hikes are pretty common.
Good point. What else?
OpenAI. They announced their next dev day and, importantly, a new $50 million community fund. This is aimed at smaller AI projects, businesses, developers.
Free money, basically.
Potentially, yeah. But the deadline to apply is August 15th. So move fast if that's relevant to you.
Okay, August 15th. And finally.
This one. Yeah, this stat really stopped me cold. AI training. It now uses more electricity than the entire country of Argentina.
More than Argentina. Seriously.
Seriously. And get this. One single ChatGPT query uses the same energy as running an LED light bulb for 2 hours.
That's staggering. The infrastructure implications.
Huge. Exploding costs are coming, not just for energy, but for everything related to data centers and computing infrastructure. It's going to ripple through the whole industry.
Okay, so pulling all these threads together, the massive AI valuations, the crypto shifts, the IPO frenzy, the energy demands, what's the bigger picture? Let me throw out maybe a controversial take here.
Go for it.
AI agents. Everyone's talking about them, building them, funding them. My contrarian view, they're basically just expensive middleware, and they're going to get commoditized fast, maybe within 18 months.
Okay, interesting. Elaborate on that. Why expensive middleware?
Well, it feels like everyone's chasing the shiny new object, right? Autonomous AI agents, millions are being poured into these platforms.
The hype is definitely there.
But the uncomfortable truth, I think, is that underneath all the fancy marketing, they're mostly just complex API orchestrators. They string together calls to different services or models.
Okay.
And we've seen this movie before, haven't we? Remember robotic process automation, RPA?
Yeah, 5 years ago, that was the future of automation.
Exactly. Everyone was piling in. And now, RPA is largely a commodity. A standard tool, sure, but not the revolutionary platform it was hyped as. I think AI agents are on the exact same trajectory, just moving much, much faster.
So you're saying the real value isn't in the agent itself?
Precisely. The real enduring value isn't in that top layer, the agent platform that everyone's building and selling right now. That's going to become interchangeable, commoditized.
So where is the value then?
It's underneath. It's in owning the data pipelines that feed the AIs. And it's in owning the robust, reliable decision-making frameworks that these agents, or whatever comes next, will interact with. That's the foundation.
Okay, I see the argument from a long-term control perspective, but what about the short term? Aren't these agent platforms selling the idea of accelerating development now? Isn't there value in that speed, even if it costs more or you lose some control later?
That's a fair counterpoint.
Yeah.
Yes, they might offer some initial speed up, but often that comes with a pretty big trade-off later in terms of flexibility, cost, and crucially, lock-in. While your competitors might be burning cash on these fancy agent platforms, you could potentially get the same, or maybe even better, results using simpler, well-designed scripts to coordinate your AI models.
Cheaper too, presumably.
Yeah, way cheaper, like 90% cheaper. And critically, you keep full control over your data and your processes. So my definitive advice here, skip the AI agent hype train.
Gold. So what should people invest in instead?
Invest in rock-solid data infrastructure. Build deterministic workflows processes designed to be predictable and reliable, no matter which AI model you plug into them. Let everyone else chase the shiny agent thing. You build the foundation.
That definitely raises a key question for long-term strategy. Are you building for today's hype or tomorrow's actual value?
Exactly. Okay, let's try and wrap this all up, connect these dots. Jensen Huang, NVIDIA's CEO, famously said, "We're witnessing a $1 trillion computing inflection." And look, when the guy selling the shovels tells you it's a $1 trillion gold rush, you probably ought to start digging, right? This isn't just about AI or crypto or IPOs in isolation. It's about a fundamental shift in how value gets created, captured, the whole tech landscape.
Absolutely spot on. So with that in mind, here's a clear, actionable framework. Think about this over the next 30 days.
Okay, let's hear it.
1. Your AI vendor strategy. If you aren't already thinking multi-model, start today. Seriously, with these valuations, single vendor lock-in, that's becoming vendor prison fast.
Right. Avoid the hostage situation.
2, crypto infrastructure. Look, forget whether you personally love or hate Bitcoin. Stablecoin legislation is coming and it will change payments. Test it. Just do one international transaction with stablecoins, see the savings, the arbitrage is real.
Test and verify. Got it.
And 3, IPO awareness. Remember, 196 companies went public recently. Statistically, at least 5 of those are probably your competitors or key suppliers. Know who they are, prepare for them to make aggressive moves with all that new cash.
Good framework. Prepare for impact.
Prepare for impact.
Because ultimately, isn't it true that the really big fortunes in tech, they aren't usually made by just using the latest platform. They're made by building the things others end up depending on, the infrastructure.
That's often the case, yes. So, connecting it all. While everyone else is maybe chasing the hottest AI model or the buzziest crypto token, maybe you should ask yourself a different question.
Which is,
What infrastructure, what fundamental capability are people going to need regardless of which specific model wins or which token becomes dominant? Where's the enduring underlying value?
that's the question to ponder.
That's the question.
All right, that is our deep dive for July 30th, 2025. We'll cut through the noise and bring you the insights that matter again next week.
Until then, stay bold, stay curious, and remember, in this world of tech, the biggest risk, it's usually not moving too fast, it's moving too late.